Hello, everyone. Welcome to episode 3 of the Chamber Music Mindset. This week we have another weekly chat like the one we had last week. I'm going to go over some of the things that we learned last week in terms of economic data as well as some earnings information and what that tells us about where we are with tariffs and AI and other interesting things. And then we're going to talk about what we should be expecting this coming week. Okay, so last week, let's start with the Fed. That was the big news of the week that moved the markets. The Fed didn't change anything, and that is something that we talked about last week as expectations that they probably wouldn't do anything. Now, that was expected. What was not expected was that there were two dissenters. Christopher Waller, which is the governor that we talked about at our last episode. It wasn't unexpected that he would dissent. He was for cutting when the Fed didn't do anything in terms of changing policy. Michelle Bowman also dissented. So we had two dissenters in an institution that normally comes out in a unified front of full consensus. And this hasn't happened in over 30 years. So this was very significant. It's also significant because of the political environment that we're in, with a lot of pressure to cut interest rates coming from the White House. So this was a very interesting week for the Federal Reserve policy announcement. Even though it changed to nothing, there was a lot to talk about underneath the surface. But that's not what we're going to talk about today. What we're going to talk about is the data. So what's interesting was the Fed came out to say that there was no cut on Wednesday. But then on Thursday and Friday, after that policy decision, we had two sets of data points that actually meant a lot in terms of policy. So the next time they meet is in September, and there's going to be a lot of speculation about what the Fed will do in that September meeting, including from yours truly. Okay, so let's talk about the first thing that happened. On Thursday, we got the PCE numbers. Now, the PCE deflators are the inflation gauge that the Fed likes to look at. So it's the Fed's favorite gauge of inflation. Now, it came in higher than expected. On a year-over-year basis, the core PCE, core means we're taking out energy prices and food prices because those things tend to go up and down a lot. And they tend to be volatile. So we're looking at the core. It came in at 2.8% year over year when we were expecting 2.7% year over year. So it was a little bit higher. We don't like it when things are not in the direction, when it surprises in the direction that we don't want it to be. We don't want higher numbers because the Fed's target is at 2%. So 2.8% from 2% target, missing the expectation of 2.7%, not necessarily a great look. On a month-over-month basis, we're talking about 0.3%, which was higher than what we had the month before, which is at 0.2%. Now, you might say 0.2, 0.3, what's the big deal? It is a big deal on a month-over-month basis when you annualize it, right? We look at everything from year-over-year basis, annual basis. We're talking about something from a 2 handle to a 3 handle. So those are big differences. So on a month-over-month basis, also a little bit higher than what we would have liked to see. So in all, the inflation gauge came in stronger than expected, certainly away from where the Fed wants inflation to go. So in some ways, it actually solidified or confirmed the Fed's decision on Wednesday. However, on Friday, we got a different type of a data set from the Bureau of Labor Statistics, and that's the labor market data. Last week, during our weekly chat, I said that there was a weakness in the labor market data. The 40 some odd pages of labor market data that we get every month. Forget the headline numbers. We're talking about 40 some odd pages of numbers that a lot of people look through. There are a lot of weaknesses, and we've been seeing weaknesses for a while. It just never got to the headline number. Well, on Friday, we got some bad news. Normally headline numbers are really great, and I have to look deeper into the data to see if there are any indicators that may be telling us something else, and that's what I've been looking at. Now this time the headline numbers were actually in our faces bad. So headline for July came in at 73,000 jobs gained. That is called non-farm payroll, when the consensus was at 104,000. So that was a very, very big miss. And when it's at 5 figures or so, it starts to become really weak. I mean, if we have continuous, month over month or consecutive months of 5-figure job gains, we have something to worry about. But the story wasn't even in the July headlines. It was actually in the revisions. So here are some numbers. May job number was revised downward from 144,000 to 19,000, 144K to 19K. Massive revision downwards. June was revised down from 107,000 to 14K, 14K. 147K to 14K. That is a huge, massive revision. This is not a good look. Now, this gives you an idea of what I mentioned last week about the weakness in labor market, right? That is lurking beneath the surface. Now, I would look at this from a combination of factors. The past is catching up to us. There's no such thing as free lunch. Prices go up, interest rates are high, something is going to give at some point. And I think that things were starting to give a long time ago, but in the fringes, and then maybe the employers are saying enough is enough. The other thing is, what could have exacerbated it? Tariffs. If you're facing tariffs, you're going to face tariffs, but every day it's changing from 15% to 65% to 30%. You have no idea how to plan for your business. And if that's the case, I'm going to hold off on hiring for now and make do with what I have. And that is a very, very big disincentive to hire people. So the freeze or stalling from tariffs could be one reason as well. The other is, and I alluded to this last week very briefly, this is a statistical game. So last week I said nobody's going out there and actually counting the numbers of jobs that we're gaining, right? What this is there's a survey, there's a sample that is being taken in terms of surveys. And what they do, and it's why it's called employment survey and establishment survey and household survey. And then it goes into a gigantic statistical machine that is being not only seasonally adjusted, but also adjusted in multiple other ways in a statistical manner. So it is a statistical game. One thing is that the model is biased toward more recent trends. So if more recent trends have had, hundreds of thousands of jobs, like 150,000 jobs, 175,000 jobs, or even maybe 300,000 jobs. These are great numbers. And so the recent data will skew the number toward a more positive, tilt it toward more positive numbers, or positive a report. Now, that can't last forever, because then it will show up on the revisions more toward reality. And I think that is what's happening, that the model is finally reaching maybe an inflection point where it is now counting in or trying to model in some of the realities of the weakness underneath. This is a guess. I'm not a statistician at the Bureau of Labor Statistics, but that is my guess, is that is what's happening. So we may be looking at an inflection point where other monthly data from now on may not look as rosy as maybe before. So that is to be continued, but I think that is what's happening, is that we're seeing an inflection point in that model. These are recession level of revisions. These types of revisions are really, they're really massive and in the wrong direction. I'm not saying we're in a recession, but we are not certainly the most robust economy right now, according to this. Now, some of this might be skewed by the fact that we have an extraordinary time of trying to recalibrate our trade relationships, and that's not something that is done gradually. Certainly, there's a lot of news coming in right now. And continuing to come in. So it might just be a temporary thing, but certainly from a historical comparison, this is a recession level type of a revision. So not necessarily good news, but we'll wait and see. So how did the markets react? Well, stocks fell and yields fell. This was a classic bad news is bad news move. So, okay, labor market data, they were bad. They were definitely bad. No other way of looking at it. Stocks actually fell on good news. Yields fell, which means that a lot of people ran away from risk markets or risk assets like stocks and went into something safer like US Treasury bonds. And just for your information, when price goes up because people are chasing something like US Treasury, yields tend to go down. They have an opposite reaction. Okay. So what do I mean by it was bad news is bad news? Sometimes in the markets, bad news is good news. And honestly, you know, my husband asked me Thursday evening, what do you think will happen? And I was like, well, it might be bad news, but then stock market might go up because it's bad news. Question is why? Well, the stock market or markets play this psychological game. Or like a second derivative game where, okay, labor news was bad. Well, Fed will be forced to cut rates now. And that's good for the markets, right? Because borrowing rates will go down. And so hooray, risk markets go up. That could definitely happen. I think this labor report was especially bad that I think the knee-jerk reaction was just, oh my goodness, we had it wrong all this time. And now we have new information and we're going to price it in for the day. I think that's what happened, but certainly there are instances, many instances where bad news is good news, but not last Friday. So that begs the question, what should the Fed do, right? I mean, so we get to a point where PCE numbers came in higher than expected. Inflation may not be where the Fed wants it, higher than where the Fed wants it. But labor markets may be stalling. And if it continues to stall, like July report was bad, if August report is bad, by their September meeting, what are they to do, right? And they're stuck between a rock and a hard place, it seems like. There are a few things that it could do. One, they could just rethink their 2% inflation target. Honestly, I can't think of anybody who knows where that 2% inflation target came from. If I remember correctly, even before the pandemic, between 2009 and 2020, their target was 2%. It's my belief that we're living in a completely different kind of a world where 2% may not make sense anymore. If we're reshoring a lot of manufacturing and making things here in the United States, the costs of making those things are going to be higher, in which case the inflation is probably going to be higher than where we expected it to be before the pandemic. And that's also true of not deglobalization, but less globalized world, right? If supply chain isn't looking for the cheapest places to make things, then of course prices are going to be higher, right? So I think that the target should be higher than 2% or wherever it was before. It could have been 3% before. I would say it should be higher than 3% because we're just living in a completely different regime. That's sort of my belief. So maybe 2% target is low. They could actually revise that 2%. That would be a huge thing to move that marker. And I actually don't think they'll do it because everyone will ask, why didn't you do this before and what changed suddenly, right? So they might still be biased to actually keep rates higher because the inflation rate is higher than their target. But what happens when labor market starts to really suffer? The Fed has two mandates. One is full employment and price stability. That's the second one. The price stability we just talked about. Full employment, that's really hard to achieve. And I don't know why the Fed thinks that it can actually achieve full employment. But if that is one of the things that they're looking at and labor market is starting to stall, it's going to become a part of their consideration. And so the question will be, should the Fed cut for the sake of making things easier for the labor market? Or should the Fed keep rates higher for longer because they're waiting for inflation to come down to 2% and they don't know what the impact of tariffs will be and it is still too early to tell. I don't know. I think that is a big conundrum for the Federal Reserve, and they have a difficult job. I'm glad I don't have that job. I think it's a very hard job. Okay, let's talk about earnings from last week. I'm going to talk about it in a thematic way because there were way too many earnings reports and I can't go over all of them. The things that I think people like to talk about and things that are noteworthy. One, there were a lot of Max 7 companies that reported last week. I'm going to talk about them in a way that the industry is talking about them now, which is who's winning the AI race and how is the market either rewarding them or punishing them. So there was an AI component to the Max 7 earnings that came out last week. I'm going to highlight a few. The winners there are two winners I'm going to highlight. One is Microsoft. Microsoft has been a real investor in AI from the very beginning. In fact, they've been really investing in AI for a very, very long time. In fact, a lot of these tech companies have been investing in AI for a long time. We've just been, as an industry, talking about it on a retail basis just for the last couple of years. Now, Microsoft has been an AI leader, and that has really come out as favorably to investors, and they hit $4 trillion in market cap, the second one to do so after NVIDIA. They didn't close at $4 trillion, but they certainly hit that mark intraday. Meta has been the other AI winner. Meta isn't selling you things like AI, OpenAI or Perplexity. Meta isn't selling you AI, but Meta is actually incorporating AI into their business, and they've been investing in their business in terms of AI. And what they've been taking their ad revenue from Instagram and Facebook and pouring that into their AI investment, and investors know that, and they've been rewarded on that. So that has been the AI winner story. The AI loser story is Amazon. Now, Amazon's a loser not only because of AI, but also it missed operating earnings, operating income, and gave us very, very weak guidance, especially with regards to tariff. I mean, what's going to happen next? Our trade negotiation with China hasn't finished, right? We don't know where we're going to end up. So that's a very, very big question mark. But certainly Amazon came out and said that they were in the very early days of AI. And the market is like, what are you talking about? You've been investing billions of dollars into AI for a very long time. How can you tell us that you're in the very early days of AI? They need to see something more. The market is very picky now and very difficult to please, especially at very high valuations. So I think that particular day, Amazon was down almost 8% or more. So we're talking about big hits. If you're disappointing the markets, maybe not super duper gains, maybe except for Microsoft, but certainly very, very picky investors. Now, the other story I want to talk about that I think is relevant is surprise tariff story. Apple. Apple is a tech company, but there's a tariff story in here. Apple hit it out of the park. Revenue forecast is better than expected. Higher sales all over the globe, including China. That was a very pleasant surprise because of all of this tension with China. I don't think the investors were expecting that big of a number or that they would outperform in China, but they did. And so investors actually rewarded them, at least in the beginning of the day. But they did talk about a hit on tariffs. 800 million hit currently, and they're expecting another $1 billion of hit from tariffs. But they're still managing to pull margins that are on the higher end of the guidance. So this is actually incredible performance, and it shows you that companies can actually do a lot to still beat expectations, maybe still meet expectations, despite this big, massive tariff hit and tariff headwind. 800 million to $1 billion is nothing to sneeze at, but they're managing to, I guess, manage their costs and increase their sales, and they're working very hard at it. The other company is Kimberly-Clark. Now, this isn't a tech company, but this is a tariff story. Kimberly-Clark, manufacturer and distributor of things like, think Huggies or Kleenex, things like that require tissues, reported strongest volume growth in 5 years, and a lot of that was organic growth. tariff impacts they believe will be less than they had initially thought. So that is really good news. And the other component that was interesting to me that I've heard before other companies talk about is the fact that the weaker dollar has been favorable to their earnings. So what does that mean? I don't know if you've been paying attention, but since the beginning of the year, all this talk of tariffs, all this talk of changing the trade relationships, that has really had an impact on the dollar on the negative. The dollar has lost its value compared to other major currencies over the last 6-7 months. Now, that could seem bad. That certainly sounds bad, and it does mean something. But when you take foreign earnings and translate it back to the US dollar, it's actually larger. So it actually, in terms of accounting, helps a lot of these companies make their earnings look bigger or losses look smaller. So, this is just a lesson in that just because we think one thing is going to happen, it doesn't mean that there's a linear relationship between what the cause is and what the final effect will be. There are a lot of things that happen in between. It's a very, very complex world and complex process. This idea of having a global company make things in various countries and bring things over, it's a complex process. So companies can have a lever in every single one of those nodes, decision nodes. And I think they're doing a great job of not only marketing their products, but also manufacturing them, sourcing them, and selling them. So kudos to a lot of companies, but certainly those tariff hits that's no joke. That's a lot of money. But it seems that they're working very hard to meet the bottom line. Okay, coming up this week, we have some economic data that's coming up that's interesting. Things like durable goods sales, which, I don't necessarily want to get into because they move up and down a lot from month over month. Car sales, that would be interesting, especially given that cars are hugely impacted by trade and trade negotiations. ISM Purchasing Managers Index. This is a diffusion index. Basically means anything above 50, number 50 means that its economy is expanding. Anything below 50 means that it's contracting, and it is very much dependent on the previous month's activity, so it's relative. That is actually a really good gauge to see how America is doing, the American economy is doing in terms of manufacturing as well as services. It's a good gauge, so that's coming up this week. International trade and goods trade balance is also coming up this week. That'll be very interesting. Normally it's not a very interesting number, but considering the tariffs and all of the behavioral knock-on effects from the tariffs, I think it'll be interesting to see. During the first quarter, we saw trade balance go way into the negative because everyone was buying, importing international goods ahead of the tariffs. And then it's kind of popped back up to more normal areas, but I think this is something to watch for the rest of the year. And consumer credit is another thing I will be watching this week. Americans have been living off of credit, either by credit cards or buy now, pay later type of schemes. And this might look good for retail sales in terms of spending, but it does not necessarily mean good news for the American balance sheet, personal balance sheet. So that's something that I'll be watching for. All right. That's it for this week. That's been long enough. Thanks for listening, and I'll catch you the week after.